Some think you need secret info or advanced financial models to succeed as a contrarian. But much of contrarian strategy relies on publicly available data, earnings statements, news articles, basic ratios, and the ability to interpret that data differently. Form a mini mastermind group. Connect with a few fellow investors who also favor data-driven decisions. Each of you picks a potentially undervalued stock, shares your logic, and gets feedback from the others. This way you leverage common knowledge in a smarter way, rather than needing hush-hush insider tips. Most crucially, contrarian investing is about reading the same info as everyone else. Only you spot the overlooked positives or overblown negatives. That skill doesn't require secret intel, it just requires a willing mind. Many assume that if a stock is unpopular, it must be a contrarian goldmine. They buy simply because everyone else is selling. This approach confuses unpopular with undervalued. An unpopular stock might be disliked for a very good reason, like flawed products, poor management, or unsustainable debt. If you jump in just to be different, you could be stepping into a money pit. When you buy a stock only because the crowd hates it without investigating its fundamentals, you risk major losses. The company's issues might be far worse than you realize. You might hold on to false optimism, telling yourself the market is wrong, when in reality, the market is fairly priced in a dime business. This mistake can crush your portfolio and your confidence. You might walk away thinking contrarian investing doesn't work, when in fact you never practiced true contrarian analysis at all. Combine contrarian thinking with structured research. Use an evidence matrix. On the left side, list all the reasons people hate the stock, like drop in sales, a scandal, or big debt. On the right side, note any counter evidence like new partnerships, a strong cash balance, or a fresh leadership team. If the right side outweighs the left in factual importance, not just wishful thinking. The practical fix is to set exit criteria before you even invest. Write down specific red flags. Example, if the company's quarterly revenue drops for 3 consecutive periods, or if a major customers ditch the brand. These are your deal breakers. If they happen, it's a signal to revisit and possibly exit your position. This way, you're patient enough to give the market time to realize the stock's worth, but not so stubborn that you ignore genuine trouble. Emotions will always be part of investing, but by channeling them through a disciplined process, you give your contrarian bets a better shot at success. Some contrarian investors do exhaustive research once and assume that analysis stays valid forever. They neglect to follow up on quarterly earnings, product launches, or potential red flags. A stock that was undervalued last year might now be fairly priced or even overvalued. If you buy a stock and never look back, you could miss huge changes, new competitors, regulatory shifts, or declining revenue. Your original contrarian thesis might no longer hold, and by the time you realize it, the stock's price might have already plummeted. Or conversely, you might miss an opportunity to sell at a premium if the market becomes overly optimistic. Schedule a quarterly deep dive for each of your contrarian positions. Every 3 months, spend a set amount of time revisiting the company's latest financials and any industry twist. Do a reversible case each time. Pretend you're someone who thinks the stock is now a bad investment. Can you find evidence that supports this negative view? If it's compelling, you may need to reduce or exit your position. Also, keep an eye on valuation drift. If the stock's price to earnings ratio has soared beyond historical norms, while earnings haven't grown that much, it might be time to reconsider. This ensures you don't hold onto a once undervalued stock that's become overheated. By regular reassessing fundamentals, you stay proactive and avoid big unpleasant surprises. You also get a chance to lock in gains if the market becomes too exuberant. This disciplined follow-up helps you refine your contrarian approach, ensuring you're always basing decisions on current rather than outdated information. Over time, that vigilance can significantly improve your portfolio's resilience and return.